Welcome to Factful Finance, where we break down complex finance topics and make them easier to understand. Have you ever wondered how the world's biggest investors like Warren Buffett build their fortunes? Spoiler alert, one of their favorite tools is the index fund. But what exactly is an index fund, and why should you care? Let's dive in and find out. Before we go any further, a quick disclaimer. This video is for educational purposes only. We're not endorsing any products or apps. Always consult a financial professional for personalized advice. So what are index funds? Simply put, an index fund is a type of investment that tracks a specific market index, like the S&P 500. Rather than picking individual stocks, you're investing in a broad selection of companies that make up the index. Think of it like buying a basket of stocks. But instead of handpicking each one, you get the whole collection automatically. Now let's break this down further. Index funds offer a way to invest in the market with less risk and lower costs compared to actively managed funds. Here's the key. While individual stock prices can rise and fall dramatically, an index fund spreads your investment across many companies. This diversification reduces your exposure to any single company's performance, which is a huge plus for long-term growth. Let me give you an example. Meet Liam, a 28-year-old graphic designer. Liam decided to start investing a few years ago, but didn't want to spend time picking individual stocks. He opted to put his money into an index fund that tracks the S&P 500. Over the years, as the companies in the S&P 500 grew, so did Liam's investment, steadily, with minimal effort on his part. Fast forward to today, and Liam's portfolio has seen a healthy return thanks to the power of diversification. The beauty of index funds is their simplicity and low cost. The management fees are typically much lower than actively managed funds, meaning more of your money stays invested where it can grow. For instance, while actively managed funds may charge fees as high as 1% or more, many index funds charge a fraction of that, often less than 0.1%. And that makes a big difference over time, especially as compound interest kicks in. But let's get a little deeper. There are different types of index funds. You have broad market index funds, like those that track the S&P 500, but you also have sector-specific index funds. These focus on particular industries, like technology, healthcare, or energy. If you're passionate about tech, for example, you could invest in an index fund that tracks the performance of the biggest tech companies out there. But remember, while sector funds can give you more targeted exposure, they can also carry more risk because they're less diversified than broader market funds. Now, let's talk numbers. A recent study by Vanguard found that over the past 10 years, the average annual return for the S&P 500 index has been around 9.8%. That's not a get-rich-quick number, but if you invested $10,000 in an index fund that tracks the S&P 500 back in 2013, by 2023, you would have around $25,000, more than doubling your money with minimal effort and lower fees. This type of steady, long-term growth is why index funds are often recommended for retirement savings. Take Noah, a 35-year-old accountant, as another example. He's been contributing to an index fund as part of his 401k for years. While Noah doesn't have to worry about daily market fluctuations, he knows that over the decades, his money will grow. In fact, if he keeps investing consistently and lets compounding work its magic, Noah could be looking at a healthy nest egg when he's ready to retire. Here's why this matters to you. By investing in index funds, you can build a diversified portfolio with minimal risk, low fees, and the potential for long-term growth. Whether you're just starting or have been investing for years, these funds can help you reach your financial goals with far less effort than picking individual stocks. In case you're wondering, how do you actually get started? It's easier than you think. First, choose a brokerage platform, whether it's Fidelity, Vanguard, or Charles Schwab. Then, research their offerings for low-cost index funds. Once you've found the right fund, simply open an account, make a deposit, and set up your automatic contributions. Voila! You're on your way to a more diversified, low-maintenance investment strategy. But remember, this is just one tool in your financial toolbox. You might also want to look into other investment types, such as bonds or real estate, to balance your portfolio and reduce risk. Before we wrap up, remember, this video is for educational purposes only. I always recommend that you consult a financial advisor who can offer advice based on your unique financial situation. So, what's the first step you'll take toward investing in index funds? Drop your thoughts in the comments below. I'd love to hear from you. And if you found this video helpful, why not hit that subscribe button so you don't miss out on more content like this? We think you'll find the video we've linked on screen next really interesting. It could be just what you need to continue your financial journey. Thanks for watching Factful Finance, and I'll see you next time.